Hello and welcome to AusBiz on this Monday. I'm Andrew Gagan. Good to have you with us as we take a look at the global view. Let's begin on Friday. What we saw as we rounded out what was generally a positive week, but stocks fell across the board on Friday, except on Wall Street. The S&P and Dow are raising earlier losses while the Nasdaq had a strong session after President Trump hinted that he'd be flexible about a new round of tariffs which are due to be imposed next week, the beginning of April. Now, for the week, the S&P 500 was up 0.5%, the Nasdaq up around 0.1%, and the Dow climbed 1.2%. Stocks specifically, FedEx shares slumped after the package delivery company cut its full-year profit and revenue forecasts, citing continued uncertainty in the US economy. And UPS also fell, with the Dow Transport Index down around 8% since the beginning of the year. Trucking stocks fell heavily, while shares of airlines, which have recently cut earnings estimates, have been hit hard. Delta Airlines and United having tumbled more than 20% this year, while American Airlines is off more than 35%. And Boeing shares climbed after the Trump administration awarded the aircraft manufacturer a contract to build the US Air Force's most sophisticated fighter jet, beating out rival Lockheed Martin. And Nike fell on Friday after the sports apparel maker projected a sharper decline in fourth quarter revenue than analysts had anticipated. Well, geopolitical developments continue to roil markets. Israeli airstrikes on Gaza and a Ukrainian drone attack on a Russian military airfield have further dampened risk appetite. Investors also worried about the financial fallout from the detention of Turkish President Tayyip Erdogan's main political rival. And US President Donald Trump's next move on tariffs remains in focus, with Federal Reserve policymakers considering if they'll lead to persistent inflation. New York Fed President John Williams saying the downside risk to economic growth and the upside risk to inflation are both very high. The yield on the US 10-year note rose modestly on Friday to 4.25%, the 2-year slipping slightly to 3.95%. And German government debt yields moved sharply higher after the country's upper house of Parliament on Friday approved plans for increased spending that aims to revive growth in Europe's largest economy and boost its military capabilities. The US dollar has edged up against the euro to mark its first weekly gain this month, and the Aussie is trading at 62.8 US cents. Bitcoin trading around 85,500 US dollars. Oil prices settled high on Friday to record a second consecutive weekly gain as fresh US sanctions on Iran and the latest output plan from the OPEC Plus producers raised expectations of tighter supply. Brent crude futures settling at $72 a barrel. Copper was little changed on Friday, while iron ore fell more than 0.5% to $101 US dollars a tonne, and gold fell 1% due to a stronger US dollar and profit taking. US gold futures falling to $3,021 an ounce. Well, for more on global markets with a focus on global debt, Chad Padowitz joining us now from Talaria Capital. Chad, welcome back. Good to see you again on AusBiz. I was just mentioning that spending we're seeing in Europe at the moment, particularly in Germany. Moreover, what are you seeing in global debt and just how much it is increasing at this point?
Yes, so I mean, debt's been the reason, that most countries have actually been able to maintain standards and keep economic growth. Has actually been debt fueled for a great part. There's about 100 trillion of global debt out there. A big chunk of that is coming up for refinancing over the next couple of years. And bear in mind that the level of interest rates a couple of years ago around the COVID period was very low. So the debt that you have to refinance now, almost in every country, will be significantly higher at an interest rate level. So that is something that should be bear in mind. The weaker countries have a disproportionately higher amount of debt coming due. So that's happening at the country level. And as you mentioned, Germany is now spending a lot more to revive their economy and military spending and so on, which is only going to make that situation worse or more, a bigger issue there and keep interest rates probably higher. The other thing on debt, it's not just at the country level, but the higher interest rates continue to impact at the consumer level. So, for instance, just anecdotally, around 10% of people earning over $100,000 in the US, so sort of starting to get into the middle income bracket, are concerned about being able to make mortgage payments. The median mortgage payment takes up about 39% of income, which is a historically very high number. And with inflation being quite sticky and interest rates probably not coming down as much as early anticipated, this will continue to be a sort of a headwind to, I think, economic growth.
Throw into that the impact of tariffs. What's the likely impact, in particular as we look more globally, I guess, at some of those vulnerable economies?
Yeah, so look, I mean, tariffs, it's hard to say where this will all land up. I think beginning of April, which is in just over a week or so, is when a lot of these tariffs come on board. So we'll see what happens between now and then. But something to bear in mind is, although this US-centric policy of America first and tariffs and what's happening on that regard, it's worth bearing in mind that, for instance, the Nasdaq 100, so the main index on the tech names, gets about 51% of revenue outside of the US. The S&P 500 is about 40%. So a substantial amount of revenue actually comes outside of the US. So anything that does impact global economies or economies outside of the US by US economic policy does have an impact, can potentially have an impact on the domestic equity market as well.
So all that said then, Chad, given that that debt situation we've seen both government and corporate, is that changing your view with your investment thesis, if you like?
No, well, the debt situation isn't necessarily new. I just thought worth bringing up that the challenges haven't gone away. Anything, they're increasing. It hasn't changed our view. We do believe that the current equity market valuation is pricing in a far more optimistic outcome than has historically been the case. And the tariff issues, the debt issues, the interest rate stickiness of inflation, all of that means that we think the probabilities of having an upside surprise to earnings is probably quite low, while the risk on the downside is probably higher. So maintaining a more defensive, better balance sheet, strong valuation, less economically cyclical type investment process, we think makes a lot of sense.
So, Chad, I know you have been looking at Europe for equity opportunity there at the moment. Specifically, what are you looking at the moment?
Yeah, so look, we are looking at companies that have good balance sheets, good business models, are not overly operating, don't have a great deal of operating leverage, i.e. if sales come down a bit, they can still maintain profitability. So, one example is a German a chemical distribution business called Brentag. So they're the largest distributor of specialty and general chemicals for paints and things like that. It's a 10 billion euro market cap business, does about 17 billion euro revenue, trades on around 12 times earnings. Their business model is to buy up smaller tuck-in acquisitions, which have done about $2 billion worth of those over the last 10 years. So that's a business that's we think can continue to compound, can continue to generate attractive returns, and because they're asset light, so they're a distributor, they don't actually have many hard assets. They're a lot less operationally leveraged than other companies.
Chad, are you seeing further opportunity in Germany, particularly as we began the conversation with that significant boost in spending, particularly in the defence space? Is that a sector you're looking at the moment?
No, we're bottom up, so we don't go via thematics or things like that. So everything's on a bottom up process. As it so happens, our process we avoid armament businesses specifically, so it's not really a place we're looking at. Germany generally, look, we think Europe is attractively priced versus the US, so we are seeing more opportunities in Europe generally, but nothing specifically in Germany. Brentag we were buying well before this recent announcement.
Chad, Always good to get a view of what you're seeing there. Thanks for joining us from Talaria Capital.
Right, welcome. Thank you.
Well, let's bring it back home now and take a look at where we're likely going. So SPI futures off 0.5% at this point, reflecting more broadly, I guess, what we saw on global markets on Friday. And of course, the focus this week will be tomorrow night's budget. Then the following day, we do get a read on inflation for February, and that comes ahead of the RBA meeting on Tuesday next week. Stay with us. We're going to get right across the open in just a couple of minutes' time.